Good afternoon. I'm Kaushal Chari, Dean of UWM's Lubar School of Business. I'm so delighted to welcome you to today's Defining Markets webinar. The Lubar School is very proud to offer this webinar series to public, sharing the expertise of top investment professionals and corporate executives and our own outstanding faculty. This series is sponsored by the Lubar School's Investment Management Certificate Program. The Investment Management Certificate Program is a highly regarded elite program in which our students learn by doing through an intense applied curriculum, utilizing top flight investment analytical tools and managing or advising on more than 7 million in real money assets. Our graduates are sought after by firms across the country and right here in southeastern Wisconsin's vibrant investment sector. I'm now happy to turn the program over to Dr. Kevin Spellman, who is the David O. Nicholas Director of Investment Management at the Lubar School and the moderator of today's webinar. So over to you, Kevin.
Thank you for the introduction, Dean Chari. Today, we're going to be talking about the American Jobs Plan, and it's titled What It Means for the Economy in Current Conditions. We've also put out in the subject line of emails to you as we announced this event, we're going to look at infrastructure spending. Specifically, it's a great pleasure to have a couple of Wisconsin executives with us today. Just to kind of comment about this American Jobs Plan or infrastructure bill. So remember, it started out as a $2.3 trillion bill that Biden was proposing, President Biden was proposing, and it covered traditional infrastructure such as roads and bridges, but also various other things to climate initiatives, to healthcare, to daycare. This 2.3 trillion last week, 10 people across the Republicans and Democrats got together and said, well, maybe we can agree on a little bit less than $1 trillion. Well, that's maybe not going to go through. So maybe the Democrats through the reconciliation could get something back up to about $2 trillion. So whatever ends up being is probably a large number. And what we'll show you today, some type of infrastructure investment is probably needed. Now, just to give you an idea of the overall, this is called the American Jobs Plan, the stimulus in the United States. Last year we had with President Trump, $2.5 trillion stimulus. And then we had a $0.9 trillion stimulus. Then we had a $1.9 trillion stimulus this year. So over $5 trillion has been spent on an economy that's a little over $20 trillion. So we've spent already about 25% of GDP on stimulating. We're only outdone by possibly Japan, depending on how you count their stimulus, and maybe Germany. This stimulus could put us at the top of the world. And this fiscal stimulus is on top of monetary stimulus. The Fed's balance sheet has grown from 4 trillion to over 8 trillion, I believe, right now. So we have lots of money being pushed out into the economy. And today we're going to be talking about infrastructure. Moving on, our two speakers today include Sean Harrison, VP Communications and Investor Relations at Plexus, and Shaw Liu, Executive VP and CFO, Wisconsin Energy. I'm going to give a little bit more complete bios just before their opening remarks. I do want to thank Riverwater Partners for being our presenting sponsor today, along with our other sponsors, Johnson Financial Group, Mergent by FTSE, UWM Foundation, ISS, and the CFA Society of Milwaukee for sponsoring this event. These sponsors make scholarships possible for my students. And so we really do appreciate them providing that sponsorship for the scholarships and also delivering this to you today. Our agenda, I'll give you kind of a 10-minute overview on just investment spending trends, and then each one of our speakers maybe have 7.5 minutes of opening remarks. I'll ask them a bunch of questions, and then we'll take questions from you. Your questions can be submitted with the Q&A feature of Zoom, and remember, this is being recorded. So let's get into just talking about investment spending trends in general. So first of all, this chart on the top shows you gross private and domestic investment and fixed investment growth over time. So this is the growth rate going back to the 1970s. As you can see, the growth rate is somewhat slowed. The gray line are recessions. Generally, investment goes down in a recession, but look what happened in our most recent recession. Went down initially and then went way up. Now, the general trend has been down. So a lot of people say we've been underinvesting in the economy. Now, that general trend in investment be down because back here, this is the internet bubble and the financial bubble, and this is investment as a percent of GDP was high, maybe too high. So possibly the reason why it's been low the last 10 years is because we've been playing a catch up. We need a demand to catch up with supply. That's one explanation. If you look at this recession, it was a strange recession. The blue line is nominal GDP growth over time. And it's been slowing. Of course, it will slow as population slows in the US economy. The dotted line, which is almost right on top of the blue line, is personal consumption spending. So normally the consumer spending goes right along with the economy, but this time consumer spending went way down. We were closed. On the other hand, investment spending, which is the red line, which tends to be way more cyclical than the economy, went down briefly, and now it's much higher. So it's a weird recession that was really a consumer recession more than an investment spending recession. Now, consumer is a much larger portion of the economy than investment spending, so this going down mattered more than the red line going up. Now, if we look under the hood and we look below the aggregate investment spending, there's some other trends. Spending on residential investment as a percent of GDP, everybody knows housing's booming. It's really been what's up. The other spending, non-residential investment as a percent of GDP, is kind of stayed lofty at a high level. So it's really the residential going up that's been driving the upward line in the overall investment spending, where this non-residential is stable, but even that hides an important trend. If you look at the overall non-residential, this is the same line here that we had here. It's made up of technology spend, it's made up of structures and other. And if you look here, it's really the reason why this has been stable is because we've been investing more and more in technology. However, structures, which is really what infrastructure spending is about, has been declining as a percent of GDP pretty consistently for nearly 50 years. Maybe we need to invest more in it. Maybe there is a reason for this bill. We've also had, over the last 10 years, pretty slow productivity growth. So the blue line here is productivity growth over time, and you can see it's slowed over time. Now, possibly the reason why productivity has slowed is because we haven't been investing in structures. But you say, well, we've been investing in technology. But think about some technology. Netflix investing in technology, does that increase productivity or just hurt the brick and mortar movie theaters? Does Amazon investing in technology so we can buy things online, does that increase productivity or does that decrease productivity of brick and mortar retailers? Same with Facebook. Online spending that's moved online has gone away from traditional sources. So the investment spending, some of it may be to increase productivity, but other of it may be just to disrupt the existing players. Investments in structures may have a different impact. Now, the investment in structures that we're talking about today, we have an expert from basically the energy sector, and an expert from a bunch of other sectors. So what I'm showing you here is the investment and structure trends by industry. These are government statistics. And if you look at power and communications, and we'll look at the blue line, as a percent of GDP, it's been growing over the last couple decades, but telecom communications has been declining. Of this, what's growing is the electric side. Other power has also been growing as a percent of GDP. Now, Wisconsin Energy, Shaw Lu will talk to this. Sean Harrison, his company is in the commercial and healthcare space. You can see we've been investing less in structures in here. They also serve manufacturing, which has been going down. So Sean can maybe talk about trends in these areas. This area is mining, and all we know the shale play from energy was booming, 10 years ago, 5 years ago, and then we have other structures. Now, looking at equipment, we also see general trends down in our investment in equipment across different industries. Whatever the case, it looks like corporations have caught on. The red line here is a survey of CEOs and what they expect to do with CapEx over the next 6 months. CapEx trends are up in the survey, and the blue line is actual investment and investments. So it looks like we're going to be investing from the corporate side. However, I will caution, it looks like debt as a percent of GDP for businesses is pretty high. Notice how it normally peaks right before each recession. Maybe we need this government help. Maybe we need the government investing in infrastructure in order to help out businesses that are indebted with these trends. So what we're going to do now is I want to introduce our first speaker, Shaw Lu. Shaw, if you could pull up your video, I'll pull up your presentation. And it's my pleasure to introduce you, Shaw Lu. She's Executive Vice President and Chief Financial Officer of Wisconsin Energy. Sorry, let me get back to your first slide here. She joined the company in 2020, basically in the middle of coronavirus. We were talking about earlier that all her meetings have been on Zoom. She's looking forward to meeting her fellow colleagues. She joined from her prior role, in a similar role where she was at CenterPoint Energy. She has 21 experiences at Southern Company and its subsidiaries and roles, including Executive Vice President, Chief Financial Officer, and Treasurer of Georgia Power. She is a recipient of numerous awards and was recently recognized as a 2020 Top 50 Women in Finance Award by the National Diversity Council. Shaw has earned a bachelor and master's degree in finance from Renmin University in China and her MBA from Emory University. She's also completed 2 years of doctorate studies in economics. She's a CFA charter holder. I welcome you, Shaw. We look forward to your comments.
Thank you, Dr. Spellman, and good afternoon, everyone. So I thought I would just spend a few minutes, cover some industry trends, and then move on to share a little bit about WEC Energy Group. And on this slide, EEI, or Edison Electric Institute, is an association representing all US investor-owned electric companies. So EEI's headline this year is that electric companies are all committed to clean energy. So overall, the industry together contributes 5% annually to US GDP, support about 7+ million jobs, and invest over $120 billion per year to build smart, clean, strong, and secure energy infrastructure. On the next slide, I show you the overall capital expenditure history as an industry. So overall, you could see that the capital investment has grown from about $75 billion per year in 2010 to about $125 billion this year. So that's roughly about 70% growth overall, or a little over 5% CAGR per year. With the investment, the electric industry is really transitioning its energy mix. So you could see that over the past decade, coal as a generation source has come down more than 20% between 2010 and 2020. And renewables and other zero carbon resources have grown to be about 40% of the energy resource mix. So in other words, the industry is clearly focused on expanding clean energy resources. So with that backdrop, let me just spend a few minutes on WEC Energy Group and specifically on the capital investment over the next several years, which we call the ESG Progress Plan. So one thing I'll point out is that as a utility company, we're not just focused on clean energy. Our business fundamental is to provide energy that is affordable, reliable, and clean. So you see some recognition on the bottom of the page. We really affirm the importance of this business fundamental. Our company, WEC Energy Group, is a Fortune 500 company with a market cap of about $30 billion, which makes us the 10th largest investor-owned utility in the US. We serve 4.6 million customers in 4 states, Wisconsin, Illinois, Michigan, and Minnesota. We also own 60% of an electric transmission company, ATC. Of our investment, about 70% are in the state of Wisconsin. We're making great progress at WEC on carbon reduction. And recently we issued our new carbon reduction goals. As you can see on this chart, we target our electric generation fleet to be net carbon neutral by 2050. In the interim, we can see that on the chart that we have an 80% reduction goal by the end of 2030 and a 60% reduction goal by 2025. You can also see on the chart that at the end of last year, we already achieved over 50% reduction. So these goals are industry leading. They are also aligned with the Paris Climate Accord and support the governor's climate goals in the states we serve. In addition to electric businesses, we also own natural gas distribution networks in the states we serve. So we also announced a goal of achieving net zero of methane emissions from the natural gas distribution lines in our network by the year 2030. So to support these goals, from a capital spend standpoint, we plan to invest $16 billion over the next 5 years. And to put it in perspective, it is if the industry is spending about $125 billion a year, so that puts us roughly about 2 to 2.5% of the industry. So you notice that about 2/3 of the capital is dedicated to the sustainability bucket, including over $4 billion investment in renewable energy. So with this capital plan, we will grow our asset base about 7% a year, which is slightly above the industry average. So this ESG progress plan supports the climate goals, helps the environment, the state economy, as well as our customers and community. So this brings to our investor focus as well. So driven by, again, providing affordable, reliable, and clean energy to our customers, this plan supports EPS growth, dividend growth, ESG profile, and positions WEC to deliver one of the best risk-adjusted returns in the industry. I think this is all I plan to share at this moment. I'm looking forward to the panel discussion.
So Sean, could you start your video? So Ines, thank you for your comments, Shaw. Sean, I want to quickly introduce Sean Harrison, and then Sean has some opening remarks as well. Sean Harrison is Vice President of Communications and Investor Relations at Plexus. It's a global leader in complex product design, manufacturing, which we're talking about here, supply chain. We've had a lot of supply chain problems recently. I'm not talking about them, I'm talking about the country, and aftermarket services. To give you an idea why Sean is a great guest here is, his company, Plexus, serves healthcare, communications, aerospace, defense, and commercial industrial sectors. It serves a lot of the economy. Prior to joining Plexus in 2020, so Sean also came in the middle of coronavirus, but he did know the company for a while. He brings some 20 years of equity research experience, and including multiple awards recognizing his insights and analysis. Prior joining Plexus, he was with Loop Capital Markets, servicing as managing director, senior research analyst for technology and supply chain. He earned his bachelor's degree in finance from the Pennsylvania State University. Sean, we welcome you.
Kevin, thank you for having me, and thank you for the introduction, as well as for creating this forum and the opportunity for me to speak a little bit about Plexus. For those that may not know of our company, we're headquartered in Neenah, Wisconsin. We were founded in 1979. We're known as a contract manufacturer. We play in what's known as the EMS, or electronics manufacturing services industry. With that, we have a goal to help create the products that build a better world. And to accomplish that vision, currently we have about 19,000 team members globally that offer, as you highlighted, full product design and development, supply chain services, new product introduction, manufacturing, and aftermarket repair and warranty services in the US, Mexico, the UK, Germany, Romania, China, Malaysia, Singapore, and soon in 2022, Thailand. We really focus in on serving customers and industries with highly complex products and demanding regulatory environments. We want to engage with partners, we engage with partners, in the aerospace, defense, and space, industrial, communications, and healthcare and life sciences market. I'll speak to a little bit about what that means as we go through these sectors. But because of this end market focus and because of our vision, in most cases, our engagements are complex assemblies or the complete production of a product or a device relative to just what someone may think of electronics manufacturing as services is assembling components on a circuit board. So very complex engagements. In our fiscal 2020, we generated revenue of about $3.4 billion, and slightly more than 40% of this revenue is associated with our industrial sector. And our industrial sector has products that support the semiconductor capital equipment market, cable infrastructure products, industrial and warehouse automation, which is going to be, we anticipate, a very robust growth market for years to come. A slightly lower than or around 40% of our revenue from the healthcare and life sciences sector. This would include products that are involved in critical care, elective surgical procedures, and testing products. And the remainder of our revenue, about 20%, is derived from the aerospace and defense sector. And these would be products that support the commercial aerospace market, defense, as well as the commercial space market, which is another market that we see having unique secular growth trends over the next few years. Our focus on providing some differentiated services within the EMS industry, customer service excellence, as well as zero product defects, while targeting these market sectors that are really in the early innings of their outsourcing journey, helped us to drive a 10% revenue CAGR for the past 3 years. That allowed us to substantially exceed the growth of our industry, which on average is about mid-single digits annually, as well as the growth of our peer group, some of which had revenue declines over that period. At the same time, we've been able to deliver that growth while providing, best-in-class operating profitability and economic returns, which our shareholders truly appreciate. As we look forward, our goal is to grow from that $3.4 billion in revenue we generated for our fiscal 2020 to about $5 billion in by fiscal 25. To get there, it's an annual revenue CAGR of about 9 to 12%. And how we get there is the opportunities for continued outsourcing in our sectors of focus. They're still in the very early innings of outsourcing. The benefit we're still seeing from our customers engaging in our industry-leading engineering services and the growth of our aftermarket services offering, as well as a growing exposure to secular growth end markets, and that would include robotic-assisted surgery, industrial and warehouse automation, which is a focus given the labor shortages our country is facing, as well as globally, and commercial space, along with just really sustaining that industry-leading operating performance. And so critical to that, and I'm going to borrow some words from our CEO in a little bit, is really advancing our environmental, social, and governance efforts. Those are closely aligned with our vision of creating the products that build a better world. And as I said, to borrow from our CEO, Todd Kelsey, addressing ESG matters is not only the right thing to do, but it will drive operational efficiencies, innovation with our team, and opportunities to engage with customers that desire ESG-focused partners, as well as ensuring that we sustain or we have great employee retention and employee engagement. And so, with that, Kevin, I'd like to thank you for the opportunity for me to introduce Plexus to this audience, and I'll be happy to discuss how Plexus sees manufacturing spending and even the potential implications from the infrastructure investments that could occur that you previously highlighted.
Thank you, Sean. And Sean, if you could pull up your video again as well. We'll start with kind of a question and answer session. I will lead this, and then if the audience has questions, they can chat in with the Q&A feature of Zoom. I'll wait, maybe 15 minutes in order to take some of those questions. I'm going to start out with one for Shaw, and I want to re-pull up one of your slides because I thought this was quite interesting. That this slide right here, you talk about the carbon reduction goals, carbon neutral by 2050, huge reduction already. And how, so these are, really nice goals. How over the next decades do you plan to achieve those goals?
Yeah, great question, Dr. Spellman. I think to achieve I call the interim reduction goals, like the 60% carbon reduction by 2025, 80% by the end of 2030, our plan is to retire older, less efficient fossil fuel generation facilities, coal, natural gas, and invest in new wind, solar, and battery storage facilities. So as I mentioned just now, for the next 5 years, we plan to invest over $4 billion capital in new solar, wind, and battery projects. So I think these facilities not only help us achieve our carbon reduction goals, they also help with job creation, help drive the state's economy. And also because these facilities have lower operating and fuel costs, we actually expect them to save customers money over the longer term. So to your point, Doctor, to get to the net carbon neutral by 2050, so between 2030 and 2050, I think we'll need to rely on new technological advancements such as hydrogen, small module nuclear, longer duration batteries, and carbon capture and sequestration technologies. So overall, we're very optimistic about our ability to achieve these goals and also about the technological development in our space.
Just as a follow-up, what is your mix right now in these areas?
Oh, right now we have, so by the end of 2020, we have brought down coal generation over the past even 5 years by 20%. So by the end of 2020, we have about renewable nuclear, about 30%, about 30% coal, and the rest as natural gas. Okay.
All right. Well, and that's great. Actually, Sean, I'm going to go over to you since we were talking about ESG just a second ago and clean initiatives, and that is part of the original infrastructure bill, investment in this area. There is clearly an ESG focus among investors and corporations. How is Plexus addressing that internally? And how is it, what is it doing with its offerings to customers?
So there's a variety of ways we can take that. So, from an internal perspective, many of the aspects of ESG were just core to the culture to begin with, before ESG has really come into vogue in terms of diversity and inclusion and strong corporate governance and a focus on community and supporting those in our community. There are a number of initiatives in place this year to reduce our environmental impact through smart metering, LED lighting, ensuring that new facilities such as the one coming online in Thailand is utilizing the best energy performance as possible. And then through our offering, there's a twofold aspect, maybe threefold. Within our engineering services, we can take the science behind a customer's product, bring that into full product design and into market with the idea of reducing kind of the environmental impact, either through the manufacturing process or particularly through the end of life of the product. So ensuring that maybe it's designed for repair, designed for warranty, and then engaging our aftermarket services business that can help bring that product back into market through refurbishment, can harvest parts so that they don't end up in a landfill, for example. And we do have some engagement, not on the, let's say, traditional vehicle space, but within commercial vehicles for electrification as well. But much of our ESG focus in terms of customers right now is more around product design and product life cycle and lowering the impact on the environment through that engagement.
Okay. I'm going to go back and forth between the two of you. And again, my questions sometimes will be on infrastructure, sometimes just to get a good reading on the economy. So I'm going to go back to Shaw and just follow up on something. You said earlier that part of getting to carbon neutral is de-emphasizing some of the coal plants and things like that and investing in renewables. Can you just explain utility finance? Just give us a utility finance 101. A lot of people that I speak with, when I used to be a utility portfolio manager, I talk with them and they say, well, if you invest in renewables, that's bad for utility companies. But could you explain how if you invest, you get a return on the investment and actually that leads to good earnings growth? So can you walk us through that?
Yeah, absolutely. So I'll focus on a couple of thoughts. One is, to your point, utilities have an obligation to serve. So in other words, if a customer moves into one of our service territories, we must provide energy services to them. So that's the ultimate calling for the industry, is to serve the customer. So we have the obligation to serve. Two, utility industry is one of the most capital intensive industries. And you heard the $125 billion annual spend and our $3 billion for WEC. So we have very long investment horizon. So most of our assets will last 40, 50, 60, even beyond years. So to make sure that utilities can sustain that kind of capital and also provide services anytime customers move into our service territories and have access to capital markets, we are allowed to earn a return on the investment. So for capital dollars we spend, we finance with our capital structure, and on average, the industry is roughly about maybe 45 to 50% debt, 55 to 50% equities you earn on the equity piece. But the other thing is, which is very important, is utilities must balance the investment returns with customer impact to make sure that we provide affordable energy to customers. So if we can become more efficient in operating our plants, reduce operating and maintenance costs, it would allow utilities to invest more capital into the system to become more clean, smart, and resilient. At the same time, we don't put a whole lot more pressure on customer rates. So I think, to give you an example, over the past 5 years, WEC has taken out over $300 million per year of O&M costs, which enabled us to support the investment in capital without putting the pressure on customer rates. I think overall we've maintained the rates pretty flat over the past 5 years. So I think that's kind of the thinking about investing at the same time holding ourselves accountable to run the business as efficient as possible.
So if I summarize this, and we're talking about infrastructure, the jobs plan, and maybe a climate component of it. If there's pushback, it's generally not going to be from the utility companies because they get a regulated return on that capital. If it's encouraged, it can be encouraged from the government. It can be encouraged by the ultimate consumers and corporations that want to invest in this. I'm going to go back to you, Sean, and talk about supply chains. One of the original components of the jobs plan was also to secure supply chains. And we spoke last night just about, a little bit, about half and half, or a little bit more than half of your manufacturing is outside the US. And I asked you, what's the possibility some of it comes back home? And you said, well, that's not necessarily as easy as it sounds. So can you talk about, why you have a big facility in Malaysia, what it would take to bring things home?
Yeah, so about 50% of our revenues are in Asia. And about 40%, give or take, within North America. But there's a couple factors at work. If you give me a minute or two to go through the history, over the past 5 years, what we've seen is more of a dynamic of the world shifting toward building where products are consumed. So within region. So within Asia for Asia, potentially. Within North America for the U.S. This is more new products, not much manufacturing shifting around, and within Europe for Europe. The great challenge is you indicate of, let's say, bringing back a lot of production from Asia is the supply chain fully isn't developed in North America. And so while labor costs are kind of coming together globally, you don't have a fully developed supply chain in North America. You're seeing investments in semiconductor manufacturing in Arizona and Texas right now, but it's going to be multiple years before those come online. And depending upon where they're going to invest in that technology, is it leading edge, is it trailing edge? But there's other products that aren't available, at least on an efficient basis, both from a cost as well as a logistical basis here in the U.S. at that point in time. And so securing semiconductors is one component, but we utilize a myriad of products in developing and creating some of these complex assemblies. And so you need a broader kind of reinvigoration or invigoration of the US supply chain and the North America supply chain or the European supply chain to really drive growth back into the US if that was the goal. One of the other things we've done is we really focus in on a campus setup. And so you mentioned we have a large exposure in Asia, it's Malaysia, but it's really cost efficient for us as well, because as you add new facilities, you can leverage the existing infrastructure and the supply chain partners that are there. So as we move forward, kind of summing it up, there is the opportunity to do more, within North America and more in the US, but it's probably going to be select products at this point in time, unless the supply chain really invigorates and evolves from where it is at this point in time.
I heard a couple of big things. One is you need the whole supply chain there if you're going to manufacture, and the manufacturing goes to where the sales are. So maybe what could be brought back home is things that we're manufacturing overseas and we're selling back to the US, but we need the supply chains here too. So what do you think the government can do to encourage companies to build more in the US? Is it subsidies or is it, what is it?
It's a very good question. I think there's, probably a multiple items that could occur, right? It could be, incentives to create the supply chain, within the US. The availability of labor is a great challenge as well. It's one of the reasons why we're seeing such demand for our customers that support industrial and warehouse automation. That would be helpful as well. And it's also, it's the customers recognizing that, there is supply chain risk. We saw a lot of that, during COVID with supply chain disruption. And so having new products they bring to market, wanting to have it closer to home. But there needs to be a broader encouragement of both, product availability as well as labor availability and talent availability to create kind of that opportunity for more manufacturing in North America and particularly the US.
So I want to ask you just a general question about the economy. As a utility company, you serve industrial customers, commercial customers, and residential customers. Can you just talk about, I've seen recently that industrial production is finally above 2018 levels. What have you seen as far as commercial, industrial, residential demand right now versus maybe last year or the year before?
Yeah, so WEC has a very balanced mix of residential, small commercial, industrial, and large C&I customers. I think for the electricity side is roughly third. So third residential, third the others. On the industrial side, we have a pretty balanced mix of industries in the region, including paper, packaging, foods, plastic, as well as foundries, mining, etc. So the good news is we don't have much exposure to like oil and gas and automobile in the regions we serve, which were hit pretty hard by the pandemic last year. So compared to 2019, 2020, the demand for electricity was about 3%, 2.9% less than 2019. And on the recovery side, I think in the state of Wisconsin, it's been very, very good. Our unemployment rate is 3.9% versus the national average of 6.1%. We're hearing that about 75% of the meal and beverage and entertainment businesses are on the way back and reopening. And I think our recovery has been stronger than the national average overall. What we're forecasting right now is for the year 2020, 2021, we think it would be better than 2020, but not particularly fully back to the 2019 level yet. So we think 2021 is kind of a recovery year. And particularly, we think the C&I customers will have a good bounce back. Residential usage last year was very high because everyone was working from home. So this year, residential usage may be less than last year, but better than 2019. So more to come on that. I think so far through the first quarter, the recovery has been a little bit better in all of the classes compared to what we forecasted for the year.
So clearly, if we invest more in infrastructure, industrial in the U.S., that would benefit you. But with coronavirus, everybody working from home and remotely, does that have a benefit to utilities as well? Because, let's just think people maybe move to the suburbs, so the building demand.
Yeah, it's true. I think it's a very good question. It's something we'll just wait and watch and see. I think I already mentioned that we do look at the usage by class. So because everyone's working from home, at least for last year, most of last year, I think we did pick up the residential usage, but we gave in the commercial and industrial usage. So over the longer term, I think we'll just have to see the remote work, housing boom, would that impact our load significantly or not? I think on the usage side over the longer term, I think the industrial development, economic development, particularly in the southeast corridor of the state, I think that may have a much bigger impact on the demand. So companies like Uline, Amazon, Foxconn, Green Bay Packaging, Milwaukee Tools, etc. So you keep hearing that they have plans to expand in the state. I think that would not only bring industrial load, it would bring residential and commercial associated with the development. So I think that for our state, we have some good tailwind economy.
Sean, can I ask a similar question to you, since you serve commercial, industrial, healthcare, aerospace, all kinds of areas. What are you seeing happening in these different sectors of the economy?
And I'll go by sector because there is a lot to touch on. Within our broader industrial sector, we're seeing significant strength in semiconductor equipment demand. And so that's about a third of that sector. And so there's a shortage of semiconductors globally, and it's a bit of a chicken or the egg. We need more semiconductors to make the product, and they need, the product to make more semiconductors. And you're seeing rising demand there for a variety of reasons, but we know that, there's more semiconductors in every device we use. We're seeing a very strong growth profile for our customers that serve the industrial and kind of warehouse automation sectors as well. We've got labor shortages, customers are looking to get more efficient. There's some very innovative partners that we've connected with as well. And so we see strong growth from our broader industrial markets. And within that, we also play in cable infrastructure. And we know, broadband speed is key, and, the lack of bandwidth is a challenge. Within our healthcare sector, we've seen, sustained demand for critical care products. We produce a variety of those products and engage with, the majority of the let's say top 20 healthcare OEMs. Within that, we're seeing a recovery in elective surgical demand. Products used for elective surgeries, which really weakened during the first half of 2020 and has been a slow recovery within that. And we're seeing the commercial aerospace market bottom, and we're seeing demand beginning to come back and signs of life. We've all seen the TSA statistics that we're back to 2019 travel levels. Our defense business has been pretty steady Eddie. And we're seeing, a lot of growth opportunities in commercial space where we engage right now as well. So most of the indicators for underlying demand are pointing up, and then we'll also have some unique engagements associated with Plexus as well that are pretty strong.
Okay, all right. I'm going to take a first question from the audience. This is a question for Shaw. Does the net zero plan also include a purchase of carbon credits? So how does Wisconsin Energy view the carbon credit system as a tool to lower the carbon footprint?
Yeah, it's a good question. We don't have a clear view yet on that yet. I think the base assumption for us is not to rely on carbon credit purchase, but rely on technology. For instance, if the small module nuclear becomes an option, I think that would be zero carbon for future energy mix, or carbon capture technology. If for our fossil fuel generation, if we could capture the carbon, I think that would provide neutrality also. And additionally, better battery technologies and even hydrogen. And so there are many other technological options that we're considering. And overall, we'd like to continue to develop our energy mix such that we could get to the carbon neutral. But
okay.
Yeah.
Thank you. Sean, a question for you, just on China. So the last week, with the G7, President Biden's talking about his rolling out initiatives against what we're doing with China. And then, of course, President Trump had his initiatives. Some of them are similar, except that I would say Biden's more engaging with the rest of the world in order to achieve some of these objectives. Specifically, you have operations in Asia, but you really don't have operations in China. Can you talk about why that decision was made? Give us maybe some details. A lot of Plexus's manufacturing capacities in Malaysia. So you're close to China, but you're not in China. So give us some perspective.
So a little bit of historical perspective. We do have two manufacturing locations within China. China, give or take, is around 10% of our annual revenue. A number of years ago, and this came about a bit under the Trump administration. Prior to that, we did see China as a robust growth market, both for domestic consumption within China as well as for export. But as the political landscape changed, we saw our partners go toward more of an in-region manufacturing for in-region consumption, and that included China. And so where we engage in China right now is more for domestic consumption, and that looks to be the case. We didn't really see significant manufacturing pulled out of China as much as the growth profile changed and customers look to engage with us in different geographies. And that to an extent is, driven our growth, let's say in Mexico or Malaysia, because of looking to vary that engagement. And based upon at least, the political landscape as we see it now, that will continue to be the case. And that's why we're adding capacity in Thailand that'll come on board in early fiscal 22 to continue to support customers in Asia, but just in a slightly different geographic location.
Okay. All right. So, Shaw, if we look at the American Jobs Plan, or just what the government can do to help out utilities, will it be subsidies for renewables? Can you just talk about what they could do to encourage some of this clean investment that you're talking about? And also talk about the economics. I think you made this comment in your opening remarks that the cost of producing through renewables has come down a lot. So maybe give us a little bit of economics of renewables versus other types of sources of fuel, and then what can the government do to encourage?
Yeah, when you talk about government, you're particularly talking about federal, right?
In this particular case, federal, but you may even want to educate us on how does the federal and the states, which regulate utilities, come into play?
Yeah, be happy to. So let's go from the utility level. So I think overall, my short answer to your question is policies would definitely have an impact on the investment in the industry. So for the regulated investment, the State Public Service Commission approves the plans. So we must file applications in Wisconsin, for instance, for the investment we announced to achieve the carbon reduction goals. So the $2 billion of investment in Wisconsin out of the $4 billion. So for all those $2 billion investment, we need to go through the application process. And in that process, we need to articulate the impact of the investment on customers, on reliability and services. So that's on the regulatory side. The state has been very supportive. You probably know that the governor of Wisconsin is heading a climate task force. So he has his goals is to reduce the carbon emissions by 60% by 2030 and 100% by 2050. Remember, our goals is 80% reduction by 2030. So our goals are more aggressive than his goals, but overall, we're supporting his goals in the state. So from a support perspective, I think we do have the state's support, and it's consistent with the state goals. On the federal side, there's a lot the Congress could do, and you mentioned the infrastructure bill. Part of the infrastructure bill is to consider incentives, tax incentives for additional renewable investment. For instance, would solar qualify for production tax credits in addition to investment tax credit? What about battery, standalone battery? Would battery qualify for ITCs or PTCs? Would Congress extend PTCs and ITCs beyond the current horizon? What about direct pay versus right now reduction of tax liability in recognizing the tax credits? So lots of things are going through Congress in discussion. So we're watching very closely, but the bottom of it is for regulated investment, the tax incentives would eventually be passed on to customers. So that would help the customer's bill over the longer term. Coupled with cost of renewables coming down, I think overall, we're optimistic about the economics of the renewable investment.
So the cost to produce electricity from renewables right now, without the incentives, can you give it as a percent higher or lower than it is, let's say, from coal?
It's all depending on, I don't think I can give you a percentage number. It is more expensive without the tax incentives. The reason why I'm hesitant to give you a number is it's all depending on how much you're using, right? So how much is the sun will shine, how much wind you will receive for wind projects. For coal, depending on the weather, we talked about the weather before the webinar. So I think overall on the standalone basis, renewables are still more expensive without the tax incentives.
Okay. Now, we had another question from the audience, and I'm not sure how much granularity you can give, so please be willing to say no if you can't give it to us. But it was asking about the ROE of, so the return on equity of electric generation from different fuel sources. Now, my guess is unless the state's giving you an incentive to invest in renewables, it's the same across the board because you get a regulated return, but is that true?
That's correct. So yeah, so it's, I don't think the state differentiates the types of investment. It's the dollar amount that becomes part of your rate base and you earn a particular return on the rate base. So I think you're right.
So a question back to you, Sean. A smaller part of your business, and actually it's been declining over time, I think, as you've been growing other parts of the business. So it's not that maybe it's declined overall, it's just the other parts are growing quicker, is the communications area. How will Plexus benefit maybe from investments in the US electric supply chain in the US? And I don't know if that goes to semiconductors, which you said is part of the industrial sector of yours, or if it's in the communications area.
Yeah, so if you see, I guess within our communications, to answer the first part, some of it was by choice as well as kind of sector declines and refocusing our efforts into products that fit our strategy of complex assemblies, demanding regulatory environments. Within some of the investments, where we would benefit more from is probably our customers, either within semiconductor manufacturing capital equipment, as you're seeing large facilities come online in Texas and Arizona in the coming years, potentially within automation as well. I know there is an existing broadband initiative out there that is already in place. I don't think there's incremental investments coming there, so that will benefit us in the future, but I don't think it's above and beyond what's already known.
Okay. Talking about the COVID pandemic, has that aided or hurt usage of contract manufacturers?
It has been, I guess, helpful in some regards, in that we had many customers that needed to get product to market quickly, and so they engaged with us potentially without even pricing in place, just asking how quickly can we get this to product. Some of it was clearly healthcare related, or let's say COVID related testing. Other dynamics that have helped us to an extent, and this was more internal, is you really couldn't do site visits during COVID. And so we developed the virtual site experience. And so our new program win rates and our funnel of opportunities are at record highs utilizing that. And then historically, kind of economic dislocations. And now this wasn't the Great Recession, but there was some clear volatility last year. Has our partners, rethinking their internal manufacturing strategy or their internal engineering strategy or, aftermarket repair and services strategy. So we've seen increased engagements as they rethink, how they'd like to go to market with new products, and whether that needs to be an internal capability or utilize the expertise of a partner such as Plexus.
Can you just talk about the merit of having a contract manufacturer versus manufacturing yourself? I know it can reduce your capital investments and focus your energies elsewhere. Just talk generally about the growth in your area of business.
And so in some instances, let's say within healthcare, it allows our partner to focus in on the science. And if we engage, from the front end, which would be the engineering side of it, to the entire, back end of it, the whole life cycle, aftermarket services, we can help design that product for manufacturing, to ensure that the new product introduction goes smoothly, to ensure that we've developed the supply chain, because in many cases this is a unique product coming to market that needs a custom supply chain. So we can get the product to market quicker, typically more cost effective, and then ensure that if warranty and repair are required throughout the life cycle, the product was designed for solid warranty and repair. In many instances, what we also bring is scale of manufacturing, right? So our global locations, they can leverage that scale within our sites, whereas they may not have that if they're utilizing a solely internal site. But typically, where we engage best is we offer a full service offering, and that reduces the cost of design, the cost to manufacture, the time to market, and the entire cost throughout the life cycle of the product. And that's where our partners benefit from our expertise.
Okay, well, we are at the end of our hour. We don't want to take you as our guests listening any longer, or our speakers. We do want to actually thank everybody for being here. This is our last webinar of our school fiscal year. Riverwater was our presenting sponsor today. We had CFA Study Milwaukee, ISS, Mergent, Johnson Financial Group, UWM Foundation, and of course our host, the Lubar School of Business. We appreciate everybody for being here, and our speakers providing us great comments today, and we wish you a great summer. Have a good day.